If you are not paying attention to what just happened in the silver market over the last 72 hours, you are about to miss something historic. Because today, Saturday, 21st February, we need to have a serious conversation. What unfolded this week is not normal volatility. It is not routine price movement. It is not retail noise. Silver did not simply rise. Silver exploded. We are looking at an 8% gain in a single week. 8% in 5 trading days. That is not background fluctuation. That is not algorithmic drift. That is capital moving with purpose. That is institutional money reallocating into safe haven assets at a pace we have not witnessed since the last major geopolitical crisis. And this is happening while most mainstream financial coverage is either ignoring it or dramatically downplaying it. Silver is currently trading near $82.80 per ounce. This marks the largest weekly advance in 6 months. And what makes this move even more significant is the backdrop against which it is occurring. The US dollar has been strengthening. Normally, when the dollar rises, commodities priced in dollars experience pressure. A stronger dollar makes assets more expensive in local currencies abroad, typically limiting upside. But silver is ignoring that headwind entirely. It is pushing higher despite dollar strength. It is cutting through resistance levels as if they are irrelevant. And when a commodity rallies aggressively against a strengthening currency, that tells you something critical about the nature of the move. This is not a technical bounce. This is not short covering. This is genuine safe haven demand. The immediate catalyst became clear on Friday. President Trump publicly stated that he is considering what he described as a limited strike on Iran. Those were his words, limited strike. This followed his warning on Thursday that Iran must reach a meaningful agreement or face what he called bad things. He explicitly stated that he expects clarity on a new nuclear arrangement within 10 to 15 days. 10 to 15 days, that is not diplomatic vagueness. That is a deadline. And when the President of the United States places a defined timeline on a foreign government while simultaneously expanding military presence in the Middle East to levels not seen since the Iraq invasion, markets react. Oil reacts, currency markets react, and precious metals react. This is the geopolitical trigger that fundamentally reprices risk. Silver has long been structurally undervalued relative to its monetary and industrial role. When geopolitical uncertainty spikes, that undervaluation corrects rapidly. If you have been accumulating physical silver during the consolidation range between $72 and $78 over the past several months, you are seeing the thesis validate in real time. Hard assets outperform during periods of geopolitical instability and monetary uncertainty. That is not theory, that is historical pattern. Now let us connect the structural forces behind this move. What we are witnessing is not driven by a single factor. It is the convergence of 3 powerful dynamics. First, safe haven demand triggered by escalating geopolitical risk. Second, sustained industrial demand that continues regardless of political developments. Third, a widening physical supply deficit that has been building quarter after quarter. Safe haven demand is the most immediate catalyst. When geopolitical tensions escalate, investors do not wait for official confirmation of conflict. They hedge exposure. They rotate out of risk assets and into assets that historically preserve purchasing power during instability. Gold performs this function. Silver performs this function. And the data confirms this rotation is already underway. The London Bullion Market Association reported a notable increase in physical silver holdings this week. The LBMA represents the deepest and most liquid physical precious metals marketplace in the world. When it reports rising physical allocations, that means institutional capital is taking delivery. Sovereign wealth funds, pension funds, and large commodity managers are moving metal into allocated storage. They are not trading paper contracts for short-term speculation. They are securing physical supply because during periods of escalating geopolitical risk, paper claims offer limited protection. Allocated physical metal provides certainty. Exchange-traded funds are reflecting similar flows. Major silver ETFs recorded substantial inflows this week. Capital is entering these vehicles at levels not observed in months. Whether one fully trusts the ETF structure or not, the inflow data itself is revealing. Institutional money is repositioning ahead of potential escalation. Investors are not waiting for the 10 to 15-day window to close. They understand that once headlines confirm actual military action, prices could already be 20 to 30% higher. Technically, momentum confirms the fundamental story. On the 4-hour chart, silver shows strengthening short-term structure. Price is trading near the upper Bollinger Band, and the bands are expanding. For those unfamiliar, Bollinger Band expansion signals increasing volatility and directional movement. We have transitioned from contraction to expansion, and the direction is upward. The moving average convergence-divergence indicator remains extended above the signal line in positive territory. The histogram is widening, indicating acceleration rather than exhaustion. The relative strength index sits near 66. That is elevated but not overbought. Overbought conditions begin above 70. In trending markets, RSI can remain elevated for extended periods while price continues advancing. Based on current structure, a sustained move above the upper Bollinger Band near $82.39 opens the path toward $86. 86 represents the next significant resistance. Beyond that, the next major level does not appear until $92. In a market that just moved 8% in 1 week, a 10% continuation toward 92 is entirely plausible if geopolitical tensions persist. Immediate support sits at the 20-period simple moving average near $77.34. Below that, the lower Bollinger Band around $70.16 becomes relevant, followed by the February swing low near $64. However, absent a sudden and decisive diplomatic breakthrough, downside retests appear unlikely in the current environment. The base case remains continued tension, sustained uncertainty, and ongoing capital rotation into precious metals. And this is only the beginning of the repricing process. Now let's move to the second force behind this surge, and this is something that many analysts consistently underestimate when they talk about silver. Silver is not just a crisis hedge. It is not only a monetary metal that benefits when fear enters the system. Silver is also one of the most critical industrial commodities in the modern global economy. And that industrial demand does not pause simply because geopolitical tensions rise. In many cases, it continues expanding regardless of political uncertainty. Approximately 50 to 55% of total annual silver demand comes from industrial applications. That means more than half of all silver consumed globally goes into manufacturing and production, not investment. That is a structural foundation that gold simply does not have to the same degree. Silver's unique physical properties make it irreplaceable in multiple sectors. It has the highest electrical conductivity of any element. It possesses powerful antimicrobial characteristics. It reflects light exceptionally well. These attributes make it essential across a wide range of industries that form the backbone of technological and energy development. Consider the photovoltaic sector. Solar panel production represents the single largest industrial consumer of silver. Each standard solar panel contains approximately 20 grams of silver, 20 grams per panel. Now think about the global renewable energy expansion commitments being implemented across China, Europe, the United States, India, and the Middle East. Governments are investing heavily in solar infrastructure. Millions upon millions of panels are being manufactured and installed every year. Each one requires silver. That demand is not theoretical. It is measurable and ongoing. Beyond solar, the expansion of 5G infrastructure requires silver in connectors and high-frequency components. Electric vehicle production depends on silver for electrical systems and battery contacts. The semiconductor industry uses silver paste in chip manufacturing. Healthcare applications rely on silver for antimicrobial coatings, wound care products, and medical imaging technologies. Defense systems incorporate silver into advanced electronics and communication systems. The list continues expanding as technology advances. The critical point here is that industrial demand provides a baseline bid under the silver market. It creates consistent structural consumption that does not vanish during economic slowdowns. Even during recessionary environments, sectors like healthcare and defense often increase demand. Analysts project that industrial silver demand will grow at a compound annual rate between 4 and 6% through 2030. That represents sustained growth over the next 5 years, independent of short-term geopolitical shocks. Now combine that steady industrial expansion with cyclical spikes in investment demand, and you begin to understand how price pressure builds, which brings us to the third force driving this move, the widening physical supply deficit. The physical silver market is tight, not theoretically tight, not emotionally tight, actually tight based on hard data. According to recent data from the Silver Institute, mine production growth remains constrained. Mining is capital-intensive and time-consuming. You cannot instantly increase output when prices rise. Developing new silver capacity requires environmental approvals, infrastructure development, equipment procurement, and years of capital investment. These timelines are measured in years, not months. For much of the past decade, silver prices were not consistently high enough to justify aggressive expansion in mining capacity. As a result, the industry underinvested in new production. Now prices are moving higher, but the supply response cannot happen quickly. There is a lag between price signals and production increases. That lag creates opportunity for investors who understand the imbalance forming beneath the surface. Recycling provides some secondary supply, but recycling rates have not kept pace with rising industrial consumption. Silver is recyclable, but the recovery rate is insufficient to close the growing gap between supply and demand. The most recent quarterly figures showed total supply declining by approximately 2.1%, while industrial demand increased by 3.8% and investment demand surged by 12.5%. The resulting deficit was approximately 250 tons, and that deficit widened compared to the previous quarter. Let that sink in. Investment demand for physical silver increased 12.5% in a single quarter. That is not incremental growth. That is acceleration. And when investment demand accelerates in a market already experiencing industrial growth and constrained mine output, inventories begin to tighten rapidly. Warehouse stocks at key logistics centers are declining. COMEX registered inventory levels are sitting at levels that would have been described as critical just a few years ago. This tightening is occurring before the full impact of the current geopolitical catalyst is reflected in pricing. We are in the early stages of repricing, not the final stages. If the standoff involving Iran extends beyond the 10 to 15-day window or escalates into actual military action, the shock to physical demand could intensify dramatically. Dealer inventories could be drained, retail premiums could rise sharply, similar to what occurred during the 2020 pandemic surge or the 2021 silver squeeze. Delivery timelines could extend from days to weeks. Reports from multiple dealers indicate that traffic has increased significantly over the past several days. Orders for 1-ounce rounds, 10-ounce bars, and constitutional silver products are accelerating. When geopolitical risk becomes tangible rather than theoretical, the smart money does not wait for confirmation headlines. It positions early. History reinforces this pattern. During the 1979 to 1980 period, silver prices surged dramatically amid the Iran hostage crisis and the Soviet invasion of Afghanistan. Prices moved from single digits to nearly $50 per ounce. Adjusted for inflation, that peak would exceed $100 in today's terms. In 2011, the European debt crisis triggered another sustained rally that pushed silver close to $50 again before correcting. The pattern is consistent. Geopolitical stress leads to safe haven flows. Physical supply tightens. Prices move to a higher equilibrium. Today's environment contains both similarities and differences compared to those historical episodes. The financial system is more digitized. Exchange-traded products provide liquidity channels that did not exist decades ago. Information spreads instantly. But one fundamental reality has not changed. Physical silver remains finite. It cannot be printed. It cannot be digitally manufactured. And when demand surges suddenly, supply cannot immediately respond. That supply inelasticity is what creates explosive moves during crisis periods. We are seeing early signs of that dynamic now. The market is transitioning from complacency to repricing. The industrial base is firm. The supply deficit is widening. And investment capital is flowing in ahead of potential geopolitical escalation. When all three forces align at the same time, safe haven demand, industrial expansion, and constrained supply, price volatility does not drift sideways. It accelerates upward. Now let us zoom out and examine the broader macro landscape, because what is unfolding in silver right now is not happening in isolation. It is part of a much larger structural shift in the global monetary system. The tensions in the Middle East are not just regional disputes. They sit at the center of the energy market, and the energy market sits at the center of the global financial order. Since the 1970s, the US dollar has maintained its dominant reserve currency status largely because oil has been priced in dollars. This created the petrodollar system. If a nation wanted to purchase oil, it needed dollars. That requirement generated constant global demand for the currency, allowing the United States to finance large deficits without experiencing immediate currency collapse. But that structure is under strain. Several nations, particularly within the BRICS bloc and their expanding partner network, have been increasing gold and silver reserves at the central bank level. They are building alternative payment systems that bypass traditional dollar channels. They are settling bilateral trade in local currencies. Saudi Arabia has engaged in discussions about accepting yuan for certain oil exports. Russia has sold oil in rubles and accepted gold as settlement. These are not isolated incidents. They are signs of incremental erosion in dollar hegemony. The Middle East is strategically critical in this context. Any disruption in that region does not merely impact oil supply, it influences the credibility of the financial architecture tied to energy pricing. If confidence in the petrodollar system weakens, precious metals benefit. Gold and silver historically reprice upward when trust in fiat structures declines. This is why the current standoff carries significance beyond immediate military headlines. It represents a potential accelerant in a slow-moving monetary realignment. If tensions escalate or remain unresolved, confidence dynamics shift. Investors seek tangible stores of value. Central banks continue diversifying reserves. Hard assets gain relative appeal. Now let us return to the immediate catalyst. President Trump's 10 to 15-day timeline for clarity on a nuclear agreement is approaching. As that window narrows, markets will react sensitively to every headline. A minor military incident could cause silver to gap higher overnight. A diplomatic breakthrough could trigger short-term profit-taking. But assessing incentive structures suggests that swift resolution is not the most probable scenario. Iran has operated under sanctions for decades. Its economy has adapted to restricted conditions. Backing down under direct pressure carries domestic political risk. Meanwhile, the United States has deployed substantial military assets to the region. Carrier strike groups and strategic bombers are not positioned casually. Such deployments involve significant logistical cost and political calculation. When both sides face internal and external pressures, miscalculation risk increases. Markets recognize this. The war premium embedded in oil, gold, and silver pricing reflects that recognition. Even if tensions temporarily ease, risk premiums tend to linger because underlying structural disagreements remain unresolved. Technically, the path forward remains defined by clear levels. The breakout above $80 has already occurred. Sustained trade above $82.39 opens the door to $86. A decisive break of 86 targets $92 as the next major resistance. That move would represent more than a 10% extension from current levels. In a market that has already gained 8% in a single week, such continuation is not extreme. It is consistent with momentum behavior during geopolitical repricing cycles. On the downside, immediate support remains near $77.34 at the 20-period moving average. The lower Bollinger Band near $70.16 represents deeper support, followed by the February swing low around $64. However, absent a dramatic diplomatic breakthrough that fully removes geopolitical risk, testing those lower levels appears less probable in the near term. When analyzing silver's historical behavior, patterns emerge. During previous crises, initial spikes were followed by consolidation at higher price floors. The 1979 to 1980 surge, the 2011 European debt rally, and even pandemic-era volatility all demonstrate a common theme. Once a new risk regime becomes visible, metals reprice and rarely return to pre-crisis levels immediately. Today, the confluence of industrial growth, supply deficits, and geopolitical tension creates conditions similar to prior breakout environments. Institutional flows are increasing. Physical inventories are tightening. Technical indicators show expansion rather than exhaustion. The market is not displaying topping behavior. It is displaying continuation structure. For investors who have been steadily accumulating physical silver during consolidation phases, the thesis is being validated. Hard assets historically outperform during periods of fiat uncertainty and geopolitical strain. Those who dismissed silver's potential above $80 are now witnessing price discovery unfold in real time. The broader question extends beyond short-term price targets. It concerns positioning. Are investors aligned with macro trends or reacting after moves occur? Markets reward preparation. When supply deficits exist before demand surges, price adjustments become sharp. When geopolitical catalysts activate in already tight markets, volatility accelerates. Looking forward into the remainder of the year, if tensions persist or escalate, triple-digit silver becomes conceivable. That is not a guarantee. It is a scenario derived from historical precedent, combined with current structural dynamics. Industrial demand growth between 4 and 6% annually continues through 2030. Investment demand recently expanded 12.5% in a single quarter. Mine production remains constrained. COMEX inventories are limited relative to historical norms. These variables do not disappear overnight, they compound. And compounding pressure in finite markets produces repricing. 5 or 10 years from now, this period may be remembered as the moment silver transitioned from prolonged consolidation into sustained structural revaluation. Investors will recall whether they acted during early confirmation phases or hesitated while waiting for perfect clarity. Right now, clarity is partial but growing. The breakout above $80 is confirmed. The geopolitical catalyst is active. Institutional capital is rotating. Industrial consumption is firm. Supply remains constrained. Technical momentum supports continuation. The remaining variable is individual conviction. Markets move regardless of participation. The difference lies in who is positioned when movement accelerates. Silver is no longer dormant. The repricing cycle has begun. The levels ahead are visible. The structural backdrop is aligned. And as Saturday, 24th February unfolds, the window to position early remains open. We will continue monitoring developments closely, especially as the 10 to 15-day diplomatic window narrows. Every update matters. Every shift in tone matters. But the foundation beneath this move is already established. Stay aware, stay disciplined, and understand the magnitude of what is unfolding.